Imagine a 50-year mortgage. Sounds like lower payments, right? That's the hook. Smaller monthly bill, same house. But here's what actually happens when you stretch debt across half a century. First, you pay way more interest, like hundreds of thousands more over time. Because your principal shrinks painfully slowly, you build equity at a crawl. If prices dip, you can be underwater for years. Second, this doesn't magically make homes cheaper. It can bid prices up. When buyers can afford higher prices with longer terms, sellers adjust. That affordability you felt? It gets priced in. Third, mobility. Life changes. Jobs, life changes. Kids, life changes. Health. With a 50-year loan, you're locked longer. Selling early means fees, maybe negative equity. It's sticky debt. Fourth, risk shifts to your future self. You could still be paying a house note into retirement on a fixed income while taxes, insurance, maintenance keep climbing. Fifth, systemic risk. If millions take on ultra-long loans, the market leans on the idea that prices only go up. That's how bubbles form. When rates rise or growth stalls, stress hits households and lenders. Now, can a president just roll out 50-year mortgages? Not really. Regulators, lenders, investors have to play along. Today, 30-year fixed is the standard. 40-year shows up mainly in loan modifications. Going to 50 would be a big shift in rules and appetite. So who wins?
Have you ever wondered what would happen if you could stretch a mortgage out to 50 years? It sounds pretty tempting, right? A lower monthly payment could free up a lot of cash. But is it actually a good idea? Let's find out. We're going to break down a $100,000 loan with a 6% interest rate and compare what it looks like over 30 years versus 50 years. We'll look at the monthly payments, the total amount you'll pay back over the life of the loan, and most importantly, how much of that money is pure profit for the bank, also known as interest. Get ready, because the numbers might just shock you. So let's set the stage. Our loan amount is a clean $100,000. We're locking in a fixed interest rate of 6%, and we have two paths we can take: a standard 30-year mortgage or this ultra-long 50-year mortgage. Which one comes out on top? Let's run the numbers and see. First up, the classic 30-year mortgage. This is the one most people are familiar with. When you plug in $100,000 at 6% over 30 years, your monthly principal and interest payment comes out to $599.55. Let's call it $600. Now, you make that payment every month for 30 years, which is 360 payments in total. So you multiply your monthly payment by 360. What's the grand total you've paid? A whopping $215,838. Since you only borrowed $100,000, the rest is interest. That comes out to $115,838. So over 30 years, you've paid more in interest than the original loan amount. That's how banks make their money. Now let's look at the 50-year option. This is where things get really interesting. For the same $100,000 loan at 6%, but stretched over 50 years, your monthly payment drops to $525.81. That's about $74 less per month than the 30-year loan. It doesn't sound like a huge difference, but that adds up over time, right? But hold on. A 50-year loan means you're making payments for 600 months. So we take that monthly payment and multiply it by 600. The total amount you pay back is an incredible $315,486. To figure out the interest, we subtract the original $100,000 loan. That leaves us with $215,486 in pure interest. You've paid the bank more than double what you originally borrowed. Let's put these two loans side by side to really see the difference. With the 30-year mortgage, your payment is about $600 a month, and you pay roughly $116,000 in interest. With the 50-year mortgage, your payment is lower at about $526 a month, but your total interest skyrockets to over $215,000. That means by choosing the 50-year option to save about $74 a month, you end up paying an extra $99,648 in interest over the life of the loan. That's almost another $100,000 straight to the bank, just for the privilege of a slightly lower payment over a longer period. Let's visualize this a different way. Think about your total payments as a pie. With the 30-year loan, about 54% of all the money you pay goes to interest. That's already more than half. But with the 50-year loan, that number jumps to 68%. Nearly 70% of every dollar you pay back is interest. Over the 50 years, you're essentially paying the bank almost 3 times the amount of your original loan. The key takeaway here is how interest snowballs over time. This is the power of compound interest working against you. The longer you borrow money, the more time that interest has to accumulate. Even though the monthly payment is lower, the extended timeline makes the loan far, far more expensive in the long run. Time is the bank's best friend, not yours. Now, it's important to add a little reality check here. You might be thinking, where can I even find a 50-year mortgage? The truth is, they are extremely rare. Most lenders in the U.S. and many other countries cap their loan terms at 30 or maybe 40 years. 50-year mortgages are typically reserved for very specific situations, like for borrowers with very poor credit who can't qualify otherwise, or sometimes for certain types of investment properties where the cash flow math works out differently. For the average home buyer, it's not really a common option. So if a 50-year mortgage isn't the answer, what can you do if you need a lower monthly payment? You do have other better options. You could look for a 40-year loan, which still has a lot of the same downsides but is less extreme. A much smarter strategy is to increase your down payment. Putting down 10, 15, or even 20% significantly reduces the principal amount you're borrowing. Less principal means a smaller loan, which automatically means a lower monthly payment and less total interest paid. So, what's the verdict? When you compare them head-to-head, the 30-year mortgage is the clear winner for the vast majority of people. Yes, the monthly payment is slightly higher, but you save nearly $100,000 in interest costs. You build equity in your home much faster, and you own your home free and clear 2 decades sooner. The lower payment of a 50-year loan is a trap that costs you a fortune in the long run. The biggest lesson here is to always run the numbers before you sign any loan agreement. Understand not just the monthly payment, but the total cost over the entire term. If you want to play around with these numbers yourself, I've dropped a link to a free mortgage calculator in the description below. Thanks for watching. If you found this helpful, give this video a like and subscribe for more simple money tips. Now I'm curious, what do you think? Would you ever consider taking out a 50-year mortgage? Let me know in the comments. See you next time.